Hey guys, welcome back to the Multifamily Investor Playbook. I'm Mark Ferris, and I'm here with my co-host, John Makarewicz. We're super excited to bring you guys another episode of the Multifamily Investment Playbook. The mission of the show is to be the ultimate guide for high net worth multifamily investors. And today we're going to be talking about real estate market cycles. Are we at the top? Are we at the bottom of the cycle right now? Unfortunately, most investors rely on what the news says. And the problem, if you do that, is you're always going to be missing out on the best deals because by the time the news says something is good or it's bad, it's too late at that point. And the good news is that we have access to proprietary information that we pay tens of thousands of dollars for, and we're in the trenches studying this each and every day. And we're going to be sharing all of our insights that we have on the market cycles here today in today's episode. So, John, it's great to be back for another show. How's life going for John Makarewicz?
Yeah, life's going great, man. It's a new year, which is always an exciting time. We just wrapped an incredible 2024. We acquired a number of just exceptional assets, and they're performing above projections. Family's doing well. Just had some great quality time with the kids. My older son and my youngest son, I have three kids, are both really into music, and so am I. So we had a lot of really cool time together, working on some music projects and fighting over who gets to play drums because we all love drums, but somebody's got to do bass and guitar too, right? So, but yeah, it's one of those things I just love that that quality time. I heard this interesting thing, where, sometimes you have the last of something and you don't realize it. So, I savor every moment with those kids because, it's that idea that one day it's the last time your daughter wants to hold your hand or the last time your son wants to cuddle with you on the couch and watch a movie. So, and, it's the nice little break for the holidays. It's just like all about that time with the kids. And so just, high on life, so to speak, and ready for 2025.
Well, I totally appreciate where you're coming from with that. We have three boys, and our oldest, I mean, he's turning 17 in April, and he's driving
Yeah.
around on his own right now. I'll tell you what a freedom piece right there when when
Yeah.
your kids start driving, and our youngest is 12 and we have a 14-year-old, three boys, and we never had the girl, John. Joanna,
Yeah.
she always wanted a little girl. We have little Bella, so I guess maybe she's our little girl, and we're thinking maybe down the road there's the grandkids. We'll have a granddaughter one day, but the time flies, and this is something, especially through the holidays, you start to reflect on that, and look back at old photos and compare, and you realize, yeah, time flies. And it's a good reminder to really reflect on the fact that we have one life to live, right? And we have one shot to really get it right. So down the road, from a financial standpoint, that you can go and do the things that you want to do, and that really brings us kind of full circle to investing. And we work really hard our whole lives, and the unfortunate thing is that in today's market, more today than ever, that more and more people are getting to the time where they're like, you know what, I want to take a step back. I don't want to like work the 40, 50 hours a week. And they just can't do that because they're not getting the returns that they really need in order to get there. And with inflation now, they realize they're getting to retirement. Their financial advisor told them to save this amount, and now they've done that. They've worked hard and they've hit their goal, but they realize that the number that they saved is not giving them the lifestyle that they want.
It's getting harder and harder, and it's something I think about a lot. We talked about our kids, but part of what motivates me is setting them up for success, because the reality is it will be continue to become more and more difficult. But what I love, and you sort of said something that made me think on this, is that if you look, here in the States, you're seeing in Canada as well, is there's been an explosion in entrepreneurship. And I think that's largely been driven by, just content like these podcasts, right? You can get out there and you can learn, and it demystifies some of those things. And so that does give me hope for the future, that a lot of young folks are out there saying, you know what, I'm going to start my own business. I'm going to control my own destiny. And, it can be a lonely path, but a super rewarding path. So, yeah.
No, for sure. And this is where, I think that, when it comes to business, the goal is to make as much income as you can. But then the second part of this is, where do you put that? Of course, I think it's really smart. You have an emergency fund, so you have some excess cash just in case, you end up, investing in the business as well, right? So you're investing in your development, so your skill set, so you're becoming more valuable asset. But ultimately, it comes to a point where you have excess funds and you need to invest it. And the goal is to build a nest egg to a point where all of the income that's coming in off the nest egg is more than looking after your lifestyle. And so this is where the big riddle is where do you put it? And there's thousands and thousands of options out there, and there's a sea of we'll say there's more of a sea of not great investments than the sea of like these are really solid investments. And so from John and I, from our analysis that we've seen, and we've seen a lot of options, especially with both of us being in real estate, we've seen that multifamily investing, and this is our overall thesis, is the safest, so the least amount of downside with the most amount of upside, where you can stack the odds in your favor. And that's what this podcast is really all about, is going over and sharing what some of these, we'll call them key advantages are. Just like, if you go into the casino, the reality is the odds are stacked against you. Now, if you own this casino, that to me makes a lot of sense. The casino owners are playing a game they know they're going to win. And so for us, this is where all the analysts, the analyzing that we're doing on these investments and the team that we've built, and that's where we've found, and we'll have another session on the importance of the right team members when it comes down to operating these assets. But it really stacks the odds in our investors' favor, and overall, it's one of the best. And this is where John and I we're putting majority of all of our focus into building something that investors can trust that they can get higher returns and their investments are safe.
Yeah, and I think the casino is such an apt analogy because did you know that basically for a casino, they know that for human psychology, they just got to give you one win out of every 54 pulls. Just think about that. One win for every 54 pulls, and that's enough to make you think you're winning, but you're not. And in some ways, it's not unlike public markets, right? Now, you may have a really great financial planner that has a very diverse, balanced portfolio built for you, and it can kind of navigate the S&P 500 and kind of operate alongside it. But if you're going out and investing in individual stocks, and that's not your full-time pursuit, you're effectively at the casino gambling. And you might think, oh, Nvidia's up X%, I'm winning, but 75 of your other stocks are down. And so, it's just that thing where for us, we know that with real estate, you can kind of effectively control it when you focus on the 4 key cycles. And this is critical. And this is what we're going to dive in today. What are those market cycles and how can you use them to your advantage?
Yeah, so good. And so diving in, that's a great segue. So yeah, there's 4 quadrants when these market cycles come and go when it comes to the real estate market. So if you think of a market cycle in general, they're between 12 and 20 years. Okay, so these are very clear if you're in a certain part of the cycle. And so the bottom left, if you think of a line that actually it starts in the bottom and then it goes up, and then it ends up coming down, and then the cycle goes on and on and on. And so by the time you start the cycle to the time you're finished, it's about 12 to 20 years.
Hmm.
And the bottom left, so where it starts on the bottom, that's called, we'll look at the quadrant, okay? That line that I just shared with you, there's an axis there, that is, you think of a cross in the middle of that line that I said. So in the bottom left of the quadrant, so is called the recovery. That's the phase 1. And in phase 1, there's no new construction because it just came off of the recession period. And so there's no new construction. There's declining vacancy. So what's happening is when it's starting to recover from the market, declining vacancy means that there are less and less empty units within a multifamily asset. Okay, so declining vacancy, it's still lower, but it's improving. It's starting to increase. So on average, we're buying assets that's about 95% occupied. We buy a 100-unit apartment building, 95 are occupied and vacancies at 5. So that means that very likely in a recovering market, that the vacancy would be, say, lower than 95%, but it's slowly itching its way up. There's some hope there. That's the beginning. That's the phase one, or the bottom left of the real estate market cycle.
Yeah, and if you can identify that and then do the research, that could be, a really just incredible time to pounce, to invest, right? But it's critical you can look ahead and just make sure that it's not just a blip, or
Yeah.
not just sort of like an anomaly, right? So that's really that time where you start paying attention, I guess, to a
Mhm.
market, right?
For sure. And this is where we have access to this. I mean, lots of different sites, but one of the main ones we look at is CoStar. And CoStar is something that, we invest tens of thousands in being, getting access. Is what commercial brokers all have access to. And so what this shows us is it shows us all the construction deliveries. And so when you look at market cycles, one of the main key factors is the not only the new construction that's starting to be approved, so permits, but also deliveries, which is even the more important thing. Is when are the competition? When is there like a 200 unit asset that's being built coming into your neighborhood that is going to give more selection to potential residents when they're looking? And generally, what happens when you have, say, a new asset, they come in and they make a bunch of, we'll say, offers, right, to incentives for residents to come in. So they'll lower their amount of rents that they're charging to get people in. And what happens is that puts pressure on all the competition in around the area. All right, so we have phase one, which is the bottom left-hand side of the quadrant. Okay, so that's the beginning of the market cycle. Now, what happens is the top left is called expansion. And this, if you can catch the beginning of this expansion period, so it comes halfway up the increase. That's where expansion starts. And then at the top of it is called market equilibrium, which means that the amount of demand, so the amount of people that need residents, they need homes, it it equals the amount of supply that's hit the market. Now, the problem with and why it gets past the expansion period and it goes into the third, which is hyper supply, is that there's not like this hard stop where construction, all these new assets that are coming online says, okay, you're overbuilding now, stop. Nope, there's no sort of line there that tells new developers to stop building because there's too much coming into the market. So what happens, there's overbuilding that happens, which gets into phase three. But phase two is a really exciting time. So what happens? Declining vacancy. Okay, so it becomes really robust. There's lots of residents that are looking for a place to live. So increasing occupancy. So, 95% is something that is easier to maintain. And we're looking at above long-term occupancy average. So if we're looking at, from through history, that it's above average when it comes down to occupancy. So declining vacancy, there's more people that want assets. There's just more demand because there's less and less, we'll say, options for them to buy. And what happens there is you have all these developers that say, okay, this is a great time to sell these projects and start building. And so what they do is they raise the money and they buy and they actually start building. They get the building permits for all these units and they start construction. The thing is, though, that it takes 2 to 3 years for that to hit the open market. So they start building in a really great market. And then by the time they build, it's past that expansion period. So now they're coming on in the phase three, which is hyper supply.
Yeah. And that's it. You said it, right at the top, but if you're reading the headlines, you might already be too late. And so that's what often happens. You look at the, kind of the reports, you see kind of the vacancy declining, you see organic rental rates increasing, and too many people are looking at the same information at the same time, and those permits get a little, beyond themselves. And as you pointed out, it takes 2 and 3 years to delivery. So, these cycles, and I think it's worth noting, and we'll kind of get back to this, but but these are like 10 and 20-year cycles. So we went through it fast, but it's not happening within a year or two, right? And so, it's kind of key to be able to also recognize when a market may be hitting that saturation point and getting into that phase three. Doesn't mean it's not a great market to invest in, particularly if you're buying an older asset and improving it. Sometimes that oversupply of Class A can actually benefit you because now you're a lower cost option for that resident that maybe doesn't want to spend $2,400 or $2,600 in rent. They want to, get that 1,800 or 2,000. But it is a very sensitive time and one you have to be definitely aware of. A market we talked about on a previous podcast is Austin. That is a prime example. They hit hyper supply in 2023 and 2024. It'll continue to be a good market because population growth, but not a great market to invest in today, or maybe even say like a year ago, right? And so operators in that market are feeling that pain because they weren't paying enough attention to what's coming next, that next phase.
Yeah, 100%. And this is where, from a timing standpoint, this is all data that's published that we analyze. And that the most challenging part, okay, I'm going to just say this because when it is a sexy time to buy real estate, everybody is telling you, yes, invest in real estate. That's when the news is all saying it's a great time, but that's the time you have to be most cautious, because you go in and say, from an investment standpoint, you're buying, or we'll just say you're investing into a project when everything is sexy. The challenge is by the time that's delivered, it may not be as strong. And this is a huge reason why Ferris Capital Partners here, we love B-class assets, because even if there's new competition coming into the market, we don't try and compete with them. We come in under them and we can charge less because our unit costs that we're buying these units are down here is between 150,000 like 200,000 a unit. And new construction, they pay, it's higher than that. They're all in costs. And so the challenge for the new developments that are coming in, they're charging $2,500 a month, where ours would come in maybe at 2,000 or even less than that. So the B-class assets is a very recessionary resistant place to invest, which is another reason that we stack the odds in our investors' favor going after these B-class assets, but then we go in and renovate them so they feel new. They have the stone countertops, right? They have the nice, nice flooring, and the light fixtures are all upgraded. They move in and it looks good, and we do exterior landscaping and nice amenities. So they can be paying, $1,800, $2,000 a month and get something that is a real strong finish, but they're not paying that higher amount, which allows us to be even more competitive on the open market than this new inventory coming on.
Yeah, it's what we love to do, and I think it's worth kind of pausing just for a quick minute. So Class A is typically defined as your newer development, developed within the last 5 to 10 years, and there's a lot of nuance here when we talk classes, so just keep that in mind. An older asset can be a Class A if kind of managed correctly, right? But your Class B is typically going to be your sort of like 90s, like mid 90s to newer, and then Class C, kind of 80s and beyond. And there has been what's been called the flight to quality. And so because some markets are oversupplied, people are looking for the quality, right? And so it's why we don't really typically buy, older assets, a big, huge question mark on 70s, anything below that, we're just not even looking at. And it's just the reality. And so we just know, and, residents are looking for that quality. And part of it is driven by the big gap in the cost of owning a home versus renting. In the United States now, for a like-kind property, you will spend $1,200 more a month to own that property than you would to rent it. And so what's really interesting, Mark, is the National Association of Realtors here in the States just released their 2024 buyer profile report. And for the past 30 years, since they've been keeping this data, the average first-time home buyer is somewhere between 28 and 31 years old. It fluctuates a little bit. In 2024, it was 38 years old. And so it just goes to show that for, just affordability is a driving factor. But there's another factor too. Residents, especially the Gen Y kind of millennial, population, and even Gen Z that are now aging up into that renter, category in their 20s, they like the flexibility. They want to be able to move if they decide they want to go somewhere different. You're seeing it in employment, right? A lot of job hopping in this generation. And so it's just to say that it goes back to why we firmly believe in housing, particularly apartment, as a exceptional investment opportunity.
Absolutely. And this is where you're right. I mean, the social norm or social acceptability to renting is more normal. And if you go over to Europe, I mean, most people rent there, right? And it's socially starting to shift now, and it's going to, yeah, there's more convenience. I don't need to look after, this, and it's less expensive. So this is a big part why we're investing into a market with the customers are growing. There's more and more people renting. So like any business, again, we look at this. This is a business when we buy these assets. We want to be getting into and investing into something where there's more people, there's more customers, potential customers that are coming on the open market. And so this is another big reason why we love the multifamily space. So we have the first two. So we have the top or the bottom left is the recovery. Okay. You come up into expansion, which is phase two. Okay. And then when it gets to a point of supply and demand equilibrium, then that shifts us over into the hyper supply, which is phase three here. And so this is where all the new sales. So we track this, right? The new permits, they're issued, sales happen. And then what happens is these then start getting built and they start coming on the open market. So these new construction starts, they get completed and they're delivered into the market. And so we track this. And so what happens is there's more starting to come on than the amount of people that actually need them. And this is where you start to see declining occupancy, so increasing vacancy, where it's harder and harder to find people to be able to take these units. And that continues on, right? These new deliveries, they keep coming on the market, even it's like, oh my goodness, please stop building, please stop getting delivered. And, the local, we'll say other apartment owners are finding it challenging, and you just have more and more competition coming out because it's like, you can't stop that, right? It's coming on the open market. And that's why, even though we're investing in the B class space, we need to know that that's coming down the pipe. And this is why we spend so much time dissecting a market and a hyper local market as what's actually coming on in the next year, 2 years out, so that when we're factoring in our initial offer price, we know what's coming. We're not surprised.
That's right. And, there's also things we need to consider here, because sometimes there's, what we call black swan event, and the pandemic is the ultimate black swan event. And so, it shifted population trends, it shifted economic trends, jobs and, businesses started relocating. And so, what's fascinating, for example, if you look at Florida, that is a market that, really the Sun Belt at large has had a lot of new supply come online. And so the key is you have to look, beyond even just that data, because it goes back to, Austin, I mentioned earlier. In some cases, there's submarkets there where they've had negative 8% organic rent growth. So in other words, operators have had to drop rents up to 8% to attract a tenant. But when we look at Florida as a prime example, Tampa is a market we love. With the supply pressures that have come on due to just all the reasons people are moving to Florida, you're not really seeing aggressive negative lease trade out. It's actually like most submarkets we're looking at, maybe 0.5%, 1%. And so that, may seem bad, but when you come in with a really great business plan and a focus on the residents, you can outperform those metrics. And so looking at our Largo investment is a great example. The Largo submarket has had a lot of supply, is right next door to Clearwater, a very attractive place for folks in the Tampa area to live. And, you might look at that and go, oh, this is a problem. But what we get into is the actual deal we're buying. And we realize that they're actually under market by like 5 to 6, 7%. And so through efficient management, by the way, Mark, and it just kind of blows my mind, but just having the leasing center open 6 days a week is a lot of getting success in an apartment investment. And the reason for that is that often we're focused on those new leases, or maybe as an investor, you're thinking it's all about getting new people in, paying that higher rent. But a bigger factor is keeping the people who are there happy and excited to live there, such that when you do renew and there is a rental increase, they're happy to do it. And Largo is such a great example. We have a waiting list amongst our one bedroom tenants and residents for 2 bedroom units. So when a 2 bedroom unit comes on the market, we're actually able to move a 1 bedroom resident to that 2 bedroom at a much increased
Mm.
rate. They love the community, they're happy, and now we can renovate that 1 bedroom unit, bring somebody else in at a higher rate. So, it's about keeping the residents happy. And I think a lot of operators really miss that. Our big goal at Ferris Capital Partners, our sort of residential side, we call Ferris Residences, is to serve 10,000 residents.
Mm.
We started a year and a half ago, so we're saying within 10 years there. And so when we focus on that resident experience, the residents take care of the bottom line, right? They drive the profitability of the deal, which then in turns take great care of our investors. So it's a big factor here as well, that even in that kind of what may look like you're in phase three, the reality is yeah, it's a little oversupply, but there's just been a door that slammed shut on new development last year. And so looking ahead, there's going to be a supply constraint
Yeah.
in those markets. So a market can actually bump up against maybe phase three and then kind of pull back into phase two, just based on larger economic
Mm.
factors.
Right, right. So this brings us to phase four, and this is recession. So the amount of new inventory, the deliveries are still coming on the market, right? The other owners in the area is like, stop the competition. Now we know that it's coming, right? So it's not like we're surprised at that, but a lot of other owners, they're just maybe not looking at the data the same way, and they're finding it harder to find residents for their properties. And that's when it shifts into recession, which is now at the bottom. And so the bottom right is where you have all these completions, they're continuing to come on the market. All sales have pretty much stopped, right? Because, investors there, they're just saying, yeah, the market's not good, I'm not investing. And so there's no new sales that happen. And then there's the slew of sales that happened in the past. They still are getting built and they're still getting delivered, until what happens is they get absorbed into the market, and then the whole cycle starts over again. And so when you're coming at the bottom of the market, the recessionary market, which is really we're going to talk about today where we are, and that's exactly where we're at in the multifamily space, you have increasing vacancy. So you have increase. When I say increasing vacancy, the amount of people that are in, it starts to lessen more and more. So the cycle is about 12 to 20 years in around, and it varies city by city. Okay, so one city could be at a certain part of the market cycle than another, and so this is why it's so important. You look at the data, and a big part of it is the new permits and the deliveries that are coming on the open market. So our proprietary data that we're looking at, so Charleston, we have about 180 units there. We have 104 units in Tampa. This is saying that right now the amount of new deliveries, they're coming on the open market right now, this last slew, and coming into 25 and 26. Those have been absorbed into the market, and we're going to see some really strong rent growth moving forward, and we're going to start to see an increase in overall pricing, and we call it like a compression of cap rates, which actually increases the overall value of the building. And we will do another talk on cap rates and how these properties are valued in another talk, because that's a whole other animal we'll talk about. But this part of the market that we're in, especially in the markets like Charleston, South Carolina, and Tampa, is I'd say a once in a lifetime opportunity to be able to get into a market where you're in a recessionary market. And the interesting thing is, if these interest rates do come down, that's only going to put fuel in the fire.
Mm-hmm.
Okay? That's going to increase the amount of bank liquidity that they're going to start putting on the market. It's going to be easier to get overall mortgages. There's going to be more people jumping in. But you want to invest in a market that doesn't feel good to invest in when it's at the bottom. The problem is that, in the past, you don't have people telling you, and that's what the goal is from this podcast, is to be sharing these insights. Say, hey guys, listen, the data is telling us we're coming into the bottom of the market. This is a great time to invest in right now, because 2 and 3 years down the road, the data is telling us that we're going to be looking back at today and saying, "Oh my goodness, how did I miss it?"
Yeah, that's right. I mean, look, the best time to buy a home in the United States, and I would suspect Canada, you could tell me, Mark, but was probably in 2008 when everybody else was running for
Yeah,
the hills.
that's right.
In fact, you
Yeah,
look at kind of the smart money, the institutional groups. I mean, so there's an asset class within investing, single family rentals. You'll hear it referred to as SFR. Groups like Blackstone, one of the largest private equity companies in the world, literally bought tens of thousands of homes just in Metro Atlanta. I mean, I think they own over 60,000 homes nationwide. You've got America Homes for Rent, Colony Homes. A lot of these big institutional players saw that the market had declined. And what also often happens in that phase four is you get to a point where assets are actually trading below replacement cost. And so that was the whole thesis Blackstone had. They said, look, we can go in and buy a single family home at 70% of its replacement cost. And they were smart enough to know that as the Great Recession wound down, and it could take years, and it did, new development will start. And then all of a sudden, somebody's got to build a home that used to cost 260 to build. Now it's 400, and it just pulls up the
yeah.
value of the resale
Well,
inventory.
John, how did that work out for Blackstone? Did it work out pretty well for them?
Exceptionally well. I'm kicking
Yeah,
myself for not scooping up a few more deals myself.
yeah. I think Blackstone's doing fairly well, it
They're
seems.
doing
But
pretty good.
yeah,
Yeah, that's
well,
right.
this is where, like, right now, to give you guys context, we're buying these property. Like, we bought 4 assets in 2024, so 272 units, 104 units, and then we added 36 units, a smaller portfolio, because it was within 5-10 minutes of our other assets in Charleston, and we're getting like 20 to 30% discounts from the peak of the market. And so these discounts, anytime you're buying at that, you're locking in a strong future value. You're locking in the price. And the beauty of these assets is not only we're getting discounts, but there's built-in upside by going in and renovating, because majority of them are classic units. We can go in, and the market is telling us today we can go in and get $100, $200, $300 above what market rents are, and we invest in areas that have no rent control. So you can raise rents at the end of the market, at the end of the 1 year lease with these residents, and you can go in and really increase value and force appreciation moving forward. So I just think, John, that I'm screaming from the hilltops, like, let's buy right now, because today the data is saying that the market is prime for buying. And what's going to happen as it starts heating up, you're going to get more and more other investors coming into the market, and it's going to get more competitive, and prices are going to go one way. The cost of building is not going down. It is only going up. And that, what you had said, was really smart, that replacement costs, we're buying these well below replacement costs, which just, it really insulates you moving forward.
That's right.
So just to take away the high level points here, guys, when it comes to the market cycle, it comes in 4 stages, right? So recovery, expansion, hypersupply, and recession. And the amount of new construction is a key element in assessing where you're at in the market cycle. And every market's different, so just make sure that you analyze the local data, and city to city, and even neighborhood to neighborhood, which is critical. And in the multifamily space, we're coming into, say, 2025 right now. We are at the bottom of the cycle, which is in the recessionary time, which is the best time. You want to get into it right now. So moving forward, guys, looking forward to the next show. Thanks for listening. If you enjoyed the show, please subscribe and share with other high net worth investors that are looking to get strong returns and protect their downside as well. Thanks for tuning in to the Multifamily Investor Playbook. We love and believe in you guys, and keep on dreaming big.